Welcome. This is the last session of the day where we will cover a number of topics related to brokers and dealers. Good afternoon. My name is Alan Kerwin. I'm based out of the New York office, and I'm joined by my colleagues, Greg McCune and Cynthia Leahy, who are from our Boston office. As we have done throughout the day, we would like to present our disclaimer where the views we express are in our official capacity as members of DRI, but are our own and do not necessarily reflect the views of the board, any individual board member, or other members of the PCAOB staff. So in this session, we will cover the following topics. We'll look at a few relevant PCAOB publications for auditors of brokers and dealers. We will share selected observations from our 2023 inspections and related requirements of PCAOB standards, along with a few illustrative examples. We will share insights regarding recent inspection results and a brief status of our 2025 inspection activities. So a topic that we've been bringing up throughout the day is our PCAOB website. It contains a lot of information that can help you increase the quality of your audit practices. For example, on the main page, you will find a link to news and events, and if you click on news releases, you will see that just about every week, the PCAOB releases information about its latest activities and reports. So far in 2025, the PCAOB has posted 38 media releases, and in 2024, there were over 100 media releases. You may have noticed that the PCAOB launched a new series of staff publications called Audit Focus. We mentioned these in earlier sessions. For example, we mentioned the one on CAMs, the second one came out on Audit Committee Communications, and the third one on journal entries. These Audit Focus publications are easy to read, usually contain about 5 pages, and cover, 1, the relevant standard, common deficiencies, reminders for auditors, and good practices. So these are excellent publications for teams to review. Also on the PCAOB website, you'll find our annual report. In fact, you'll find our annual report since 2012. And we started, as George mentioned, our inspections in 2011 and produced our first report in 2012. And so there you will see our reports since that time. We also published a spotlight. This document is written a little bit differently than our annual report and describes some of the challenges that firms face in conducting a quality audit. Finally, our staff guidance from 2014 for auditors of brokers and dealers is one of our favorites. It's a great primer for those firms that are onboarding new staff and you want to explain to them what is involved in the audit of a broker-dealer. That document actually is close to 100 pages and is broken out in the different components of an audit, so it is a great reference document. I believe now we've got a code. So the code, if you can enter, is 350. So on this slide, we're looking at some of our inspection results, and we're looking at these over a 3-year period. So you'll see on the slide there are 4 groupings. Let's look at the first grouping on the left. So this one indicates a percentage of audits with deficiencies, and we can see that on the left side of that grouping it's 2021, whereas the gray on the right side is for 2023. So we see that for 2023, the percentage of audits with deficiencies was 70%. That is really a high rate of deficiencies. Now, what contributed to the increase from the prior years? Well, in 2023, this was due to firms that we had not inspected before Every year, we do make a selection of firms that we have not inspected, but in 2023, the firms that we did select, there was an unusually high number of deficiencies. In addition, in the largest firms, there was a spike in audit deficiencies, so these two factors contributed to this spike in 2023. Let's look at the second grouping. The second grouping deals with the percentage of financial statement and regulatory areas with deficiencies. So why are these rates a little bit lower? So for example, for 2023, the average rate was 20%. So I'll use an example. On any inspection, we will select a certain number of focus areas to review. So if we select 5 focus areas, and in one of those focus areas, we find a deficiency, well, that contributes to a rate of 1 in 5 or 20%. So this is what this grouping means. So for all of the audit focus areas that we reviewed, a total of 20% were found to be deficient in terms of the audit procedures. So if you sort of overlay that second group to the first group, for 2023, for example, we can say that, well, 70% of the engagements selected for review were found to be deficient, but in those, on average, 20% of the focus areas were found to be deficient. Moving over to the percentage of examination engagements with deficiencies, the third grouping, this deals with internal controls over compliance. And every year we select about 30 engagements. And so this means that out of these 30 engagements, 15 or more of these were found to be deficient in terms of the procedures performed. Now, we do know that internal controls over compliance deals with carrying and clearing brokers. It's a lot more complex. It deals with the 4 responsibility rules. So to be able to conduct an engagement of that area or of those areas, it does require a lot of work on the part of the engagement team. The last group deals with the review engagement. So this is a lot more straightforward when you compare it to an examination of a compliance report. And FINRA did talk about some of the challenges related to the exemption report and the auditor's review report. It's still, I guess, sort of puzzling to understand why those deficiency rates continue to be high. The SEC has done a lot of work in trying to provide clarification. They've provided the necessary FAQs. FINRA has done a lot of work around reaching out to broker-dealers and trying to explain to them what the approach should be in terms of filing an exemption report, what to put in there, as well as the profession. The AICPA expert panel has put out illustrative guidance and examples. And so we should be in a situation now where there should be a lot less concern around trying to address engagements revolving exemption reports. But here we are today finding ourselves where we still are finding a lot of issues in that area. So before we get into the individual examples of some of these, we do want to bring up the topic of materiality in the context of broker-dealer audits. So materiality starts with the standard AS 2105, which describes how the Supreme Court has viewed what a material fact represents. So the Supreme Court has opined that there is a substantial likelihood that the fact would have been viewed by the reasonable investor as having significantly altered the total mix of information made available. As described in paragraph .02 of the standard, the court has noted that determinations of materiality require assessments of the inferences a reasonable shareholder would draw from a given set of facts and the significance of those inferences to the investor. Our inspection experience is such that we don't see engagement teams necessarily applying the standard as it is intended. Establishing materiality involves considering the total mix of information and all relevant facts and circumstances, including both quantitative and qualitative factors. For example, let's look at potential considerations that may be relevant. Are broker-dealers comparable to issuer companies whose shares are available to the investing public? What would the typical ownership of a broker-dealer look like? Are they the principals of the broker-dealer? Are they a private holding entity? Are they the parent issuer? Another question is, are customers typically investors in the broker-dealer? So I think that's a question that an engagement team has to assess. Is that what the standard means in terms of a reasonable investor? Are they talking about the customers? How do key users of the financial statements fit into the definition of a reasonable investor? Does it fit? If it doesn't fit, well, where might it fit? The standard does talk about other factors. So would it fit into other factors such as primary users? So other than owners of the broker-dealer, who might be the primary users? So of course, it would be the SEC, FINRA, the CFTC, the New York Stock Exchange, and other exchanges. And what might a reasonable investor or primary user, for that matter, consider to be a material fact? Is it its effect on earnings, on capital, on compliance, on measuring growth? So the standard also refers to the total mix of information considerations. So what is the engagement team's assessment of that total mix of information? So will they look at the individual financial statements? Will they look at the notes? Will they look at opinions? Whether they're qualified, whether they identify material weaknesses or non-compliance to a material extent? What about the Rule 17A5 annual filing requirement that covers many of these components, as well as supporting schedules? For example, the net capital schedule, the reserve computation, and the schedule on possession or control. Courts have also weighed that omissions are material if important to the shareholder. So this slide talks about establishing the level of materiality. So the auditor should establish a materiality level for the financial statements as a whole that is appropriate in the light of the particular circumstances. This includes consideration of the company's earnings and other relevant factors. So this is a crucial component of the standard. And materiality established determines the extent of testing of the significant financial statement line items, including the scoping, thresholds used in the performance of substantive analytics, as well as sample sizes for tests of details. Failure to properly establish an appropriate materiality level for the financial statements as a whole can lead to failing to obtain sufficient appropriate audit evidence to support the opinion, can lead to insufficient extent of audit procedures, insufficient sample sizes for tests of details, in essence, not obtaining reasonable assurance. Keep in mind, under AS 2701 and auditing supplemental information, that generally the engagement team uses the same materiality as the financial statements. If a lower level of materiality makes more sense for the supplemental information, then that lower level should be applied to the supplemental information. So AS 2105 directs the auditor to consider earnings and other factors. So this will depend on the facts and circumstances of the broker-dealer. So the consideration of earnings, here on the slide we mentioned maybe gross, maybe net. The standard does define what earnings means. So it's up to the engagement team to assess if you are consider earnings, how are you going to consider earnings? On a gross basis, on a net basis? Standard also indicates that earnings are not required as a basis in all cases. So consideration of other relevant factors. Well, what does this mean other than earnings? So during inspections, we have observed that engagement teams considered total assets and total equity as a basis. They've considered net capital and excess net capital as a basis. And they've considered other relevant factors, which we've pointed to when we were discussing primary users. So other relevant factors are the individual financial statements, significant accounts, related parties. So whatever is involved in the makeup of that broker-dealer that is significant could be considered relevant factors. So here are a few examples. A broker-dealer that had a profit focus, what would be considered as a basis for materiality? A broker-dealer that operated at break-even as a pass-through entity, for example, as a distributor of mutual funds, what could be the basis of materiality? A broker-dealer that operated at a break-even level through related party income and expense sharing agreements, what would be the appropriate basis for materiality? Another example that I'd like to share, an engagement team decides not to use earnings as a basis for materiality, but to use another basis. As a result of this, materiality established is many multiples of net earnings. As a result of this, significant accounts in the income statement are not tested. And for those accounts tested, the extent of testing is not sufficient. Material disclosures, i.e., or important disclosures, because of the many multiples of earnings level established, are not evaluated. So in conclusion, in that brief scenario, materiality that was set was not appropriate for the financial statements as a whole, and the resulting opinion is not supported. So in closing on this topic, earnings must always be considered when establishing materiality, along with other factors, even if earnings are not selected. And in our experience, engagement teams do not always summarize their thought process in the work papers, which is one of the most significant areas involving the exercise of professional judgment on the part of the engagement team. Okay, now we will go to a code.
Alan, we do have a question on materiality that came in. So the question is, can net capital be a basis for materiality if it is not a GAAP measure?
If we go to the standard requires the engagement team to consider earnings and other factors. And it is up to the engagement team to assess whether, is it net capital?
Net capital.
Net capital in these other factors would be an appropriate basis for establishing materiality. Okay.
All right, so we're going to move into our next area. So just if you didn't get it, the code is 252. And on this next slide, we illustrate some of our recent results from 2023 for some select areas, including revenue, evaluating audit results, related parties, and journal entry testing. And specifically, I'm going to spend a little bit of time talking about our experience with revenue and a couple of other areas as well. You'll note that we had a 48% deficiency rate. So we looked at revenue approximately 90% of the time in our inspections. and we had a deficiency about half that time. So specifically with regard to revenue, these deficiencies were observed across different sources of revenue, including commissions, investment advisory fees, mergers and acquisition and other advisory fees. Some of the common deficiencies included auditors that did not adequately respond to the risks of material misstatement for each relevant assertion of significant revenue accounts and disclosures in accordance with AS 2301. We had a number of audit sampling deficiencies under AS 2315. For example, some firms used sample sizes and substantive procedures that were too small because these procedures were designed based on a level of control reliance that was not supported due to deficiencies in the testing of controls that had been performed, or in some cases, there was no control testing at all. And then we also had some deficiencies with respect to the performance of substantive analytical procedures under AS 2305. So we're going to work through a couple of scenarios here tied to some polling questions that will, I hope, illustrate some of the situations that we've come across. So I'm going to read the scenario here, and then we'll have a multiple choice response opportunity. So we have a broker-dealer that reported merger and acquisition advisory fees of $10 million on its statement of income and disclosed the following. Mergers and acquisition advisory fees were comprised of $8 million of placement fees and $2 million of retainer fees. Retainer fees are earned on capital placement services and are recognized in accordance with the relevant contract. Retainers are non-refundable and offsettable against placement fees, i.e. they reduce placement fees that are earned at the close of the arrangement. Revenue from retainers is recognized when the broker-dealer has delivered the services as detailed in the contract. So with that scenario in mind, we'll go to this polling question. So which is the most significant factor in assessing the broker-dealer's recognition of retainer fees under ASC 606? Is it A, when the retainer fees are received, B, the nature and satisfaction of performance obligations in the capital placement contracts, C, the retainer fees are non-refundable, or D, the retainer fees offset or reduce placement fees when the placement fees are earned? So we'll take a moment and give you an opportunity to respond to that. Still got a few responses coming in. Okay, I think we've slowed down, Brian. Okay, so here are our polling results. So the most popular answer is B, which is the correct answer. The auditor should evaluate the terms of the broker-dealer's merger and acquisition advisory contracts to understand the nature of performance obligations associated with the contracts and when the broker-dealer has satisfied the performance obligations. Just to quickly go over why the other ones are incorrect. Answer A is incorrect because the receipt of a fee alone does not indicate that revenue has been earned per ASC 606. It may be appropriate to recognize revenue before or after its receipt, depending on when and how the related performance obligations have been satisfied. Answer C is incorrect because ASC 606-10-55 indicates that an upfront fee may be an advance payment for a future good or service, and therefore would be recognized as revenue as those services are provided. And then answer D is incorrect because the ASC 606 model is to recognize revenue when or as performance obligations are satisfied. If there are separately identified performance obligations, it's possible that revenue, such as retainer fees, should be recognized prior to the capital placement transaction. In that case, the amount of revenue recognized at the time of the capital was placed would be reduced by the previously recognized retainer revenue. However, if that assessment is that the contract contains a single performance obligation associated with successful placement, any revenue, including the retainer fees, would be deferred until that performance obligation is satisfied. In instances where the contract does not include services other than capital placement, the credit of retainer fees from the final placement fee may be an indicator that the retainer fees are part of the overall compensation in connection with performance obligation related to the placement activities. In other words, there is only a single promise in the contract and therefore only a single performance obligation. As a reminder, the steps in applying ASC 606 revenue recognition principles are as follows. 1, identify the contract. 2, identify the performance obligations. 3, determine the transaction price. 4, allocate the transaction price. And then finally, recognize revenue when performance obligations are satisfied. Typically, identifying the contract does not propose a significant challenge on broker-dealer engagements. However, identification of the performance obligations, particularly for investment banking or advisory-type broker-dealers, may not be straightforward and is an area where we believe firms need to continue to focus. Okay, so next we'll go to a scenario related to 12b-1 fees. So we have an introducing broker who offers mutual fund investments and uses a reputable clearing broker for trade processing. The clearing broker calculates and remits 12b-1 fees to the introducing broker based on net asset value and the applicable fee rate, and reports the 12b-1 fees to the introducing broker in monthly clearing statements. The engagement team determined that there was a fraud risk related to revenue recognition for 12b-1 fees and assessed the control risk for 12b-1 fees as high. For a sample of 12b-1 fees, the engagement team recalculated the monthly 12b-1 fees based on net asset value and the fee rate obtained from the mutual fund prospectus. So based on that fact pattern, please take a look at the following polling questions. Which of the following provides the most reliable audit evidence to support the net asset value? A, monthly customer account statements provided by the clearing broker which show the NAV. B, an internal spreadsheet prepared by the broker-dealer which shows the NAV. C, a clearing statement from the clearing broker which shows detailed 12b-1 fees. Or D, any of the above. So please take a moment to answer that. We still have some votes coming in. Okay. So right now, the leader in the clubhouse is A, with 44%, and the correct answer is A. AS 1105, paragraph 8 states that reliability of evidence depends on the nature and source of the evidence and the circumstances under which it is obtained. Evidence obtained from a knowledgeable source that is independent of the company is more reliable than evidence obtained only from the internal company sources. A clearing broker may be considered a reliable external source in an audit of an introducing broker. Factors the engagement team should consider when evaluating the reliability of information obtained from a clearing broker may include, but are not limited to, the relationship between the introducing broker and the clearing broker and the roles each play in transaction initiation and recording. B, the audit evidence obtained from the clearing broker, including, audit evidence obtained from the clearing broker that originated from the introducing broker, and the extent of regulatory oversight of the external source. In this scenario, the net asset value included in the customer account statement produced by the clearing broker can be used as a form of evidence that the auditor inspects when performing substantive procedures over 12b-1 fees, as this information originated from the clearing broker, which can be considered an external source. An important factor related to determining if the source is reliable is related to the extent of regulatory oversight of the external source. Information from external sources that are subject to regulatory oversight or a statutory mandate typically undergoes rigorous verification processes and would likely be considered more reliable than information from external sources with little or no oversight or statutory authority. To put that into context, this would refer to the financial responsibility review rules that the clearing brokers are subject to, as well as the FINRA account statement rule, Rule 2231. Other points to consider when evaluating the reliability of external sources include evaluating clearing broker-dealer's reputation and knowledge and the circumstances under which the customer account statements are obtained. Just quickly, answer B is incorrect because the engagement team cannot rely on the internal spreadsheet as audit evidence for the net asset value without performing additional procedures, specifically testing the completeness and accuracy under AS 1105, paragraph 10. Answer C is incorrect. The engagement team cannot rely on the clearing statement as audit evidence for the NAV without performing additional procedures. Excuse me. The customer account statements are not part of the introducing broker-dealer's books and records or information system. However, the clearing statement is the result of transactions that originated from the introducing broker and therefore is a source of accounting information for the introducing broker itself. As such, the clearing statement is deemed as information produced by a service organization, not information from an external source. If we varied that scenario slightly, so for example, if the engagement team took a controls reliance approach and used controls effectiveness at the service organization to support its conclusion regarding the reliability of information produced by the service organization, then a service auditor's report should be obtained and evaluated. As part of this evaluation, the auditor should determine whether specific tests of controls over the accuracy and completeness of information contained in the clearing statements and results in the audit report are relevant. So in other words, if you took a control reliance approach, got a SOC 1 report, performed relevant procedures under AS 2601, there may be an opportunity to rely on those clearing statements in that scenario. Moving on to the next. Well, I think we talked about that a little bit just now, but we did get a question from outside that said, what if the 12B information is covered by the SOC 1? So right, if it is addressed in the SOC 1 report, and you obtain the SOC 1 report, you perform the procedures under 2601, including assessing the reputation of the service auditor, identifying the relevant control objectives, making sure that the procedures to test the controls related to that control objective and that report or the information contained in that report are covered by those tests addressed in SOC 1. There would be an opportunity to rely on the SOC 1 for 12B1 information. Hopefully I addressed that to that person's satisfaction. Okay, moving on. Let's talk a little bit about the notion of evaluating audit results. And typically, with respect to evaluating audit results, we're typically talking about identifying gap departures as part of our inspection procedures. The most common examples we see are in revenue, and specifically with regard to revenue, we see a number of disclosure deficiencies, including failure to sufficiently disaggregate the revenue line items, and as well as providing insufficient disclosure around performance obligations and payment terms. We also see gap departures related to cash and cash equivalents. Some broker-dealers appear to have improperly classified certain financial instruments as cash and cash equivalents, but they don't meet the definition of cash and cash equivalents as contained in the GAP Master Glossary. And then we also have seen a number of deficiencies related to securities owned. Specifically, some broker-dealers appear to have accounted for trading securities under the provisions of ASC 320 and excluded the changes in fair value of certain debt securities from net income. ASC 320 is generally not applicable to trading securities of broker-dealers. In So typically, broker-dealers should be following with respect to trading securities, broker-dealers should be following ASC 940, in which case you would be including the change in fair value as a component of trading gains or losses. So the next topic I want to touch on is segment reporting. And Mark from FINRA, I apologize, we didn't coordinate, so this may be a little bit redundant to some of Mark's remarks, so I'll go through this fairly quickly. But ASU 2023-7, which was an amendment to ASC Topic 280, became effective for public business entities this year. Public business entities does include broker-dealers. Most broker-dealers do consider themselves a single segment entity, and so the requirements are somewhat streamlined, but the amendment to ASC 280 did provide specific requirements that are applicable to all public business entities, including identification of the chief operating decision maker, a narrative explanation of how the CODM uses information in his or her processes, and then disclosure of significant expenses considered by the CODM. We're going to show you just, there's first, before we get to this, there is another CPE code, 489. Again, 489. So this slide here is an example of a segment disclosure for a broker-dealer that considers itself a single segment entity, but does include the relevant disclosures around who the CODM is. It talks about disclosure that the CODM uses net income to manage the business, but also excess net capital to make operating decisions. It notes that the BD is a single operating segment and therefore a single reporting segment. And then it notes that the segment expenses are consistent with the expenses reported in the income statement. Just as an aside, so as we've been looking through broker-dealer filings as part of our inspection selections process, we have noticed that, frankly, I was pleasantly surprised that the majority of broker-dealers have, in fact, complied with this requirement, or at least identified that they did have to provide some disclosure. The quality of the disclosure, I'd say, varies from very good to perhaps some lacking. But again, I was pleasantly surprised at how many BDs did, in fact, were aware of the requirement and did comply. We did see some that have not complied, and obviously that's a concern. But for the most part, most broker-dealers were aware of the requirement and did make the appropriate disclosures. So with that, I'm going to turn it over to Cindy, and she's going to start talking a little bit about related parties.
Yes, so related party transactions is another frequently reviewed focus area during broker-dealer inspections. And similar to what we've just done, let's work through a case study on related parties. So here's our scenario. We have a broker-dealer who is a member of FINRA. It is subject to an intercompany expense sharing agreement with its parent and other affiliates, where certain indirect expenses incurred by the parent are allocated to the broker-dealer and the other affiliates. Indirect expenses subject to allocation are initially recorded on the general ledger of the parent. The parent allocates the expenses to the broker-dealer based on the methodology per the agreement. The engagement team determined that there was a risk of material misstatement related to allocated expenses. So we have a polling question. Which procedure or procedures would be the best audit response to the risk of material misstatement for allocated expenses? A, obtain the intercompany expense sharing agreement and inquiring of broker-dealer management regarding the allocated expenses. B, evaluate the expenses recorded by the parent that were subject to the allocation methodology. C, evaluate the reasonableness of the allocation methodology and whether it was accurately applied, or D, a combination of the above procedures. Okay. Looks like the majority of you got the correct response, which is D, a combination of the above procedures. AS 2410 provides requirements to identify and address risks associated with related parties, including whether the company has properly identified, accounted for, and disclosed its related parties and relationships and transactions with related parties. Typically, a combination of procedures similar to the procedures in responses A to C would be necessary to respond to the risk of material misstatement of expenses allocated to the broker-dealer. Keep in mind, though, that if fraud or other significant risks are identified related to allocated expenses, the auditor's response should specifically address those risks. I'll briefly run through why A, B, and C alone would not be sufficient. Answer A alone is insufficient because inquiry alone is not a sufficient response to the risks of material misstatement. Answer A is consistent with examples we have observed during inspections where the nature of the engagement team's procedures were limited to retaining a copy of the expense allocation agreement and inquiry of the broker-dealer. AS 2410 does reference other PCAOB standards such as AS 2301 and paragraph 17 of AS 1105 that provide that inquiry of company personnel by itself does not provide sufficient audit evidence to reduce audit risk to an appropriately low level for a relevant assertion. Answer B alone is insufficient because the engagement team should generally perform procedures to evaluate the total expenses recorded by the parent that are subject to the allocation. The nature and extent of the procedures necessary would be dependent on the facts and circumstances, including the terms of the applicable expense sharing agreement, as well as the engagement team's assessment of the related risks. It is not necessary for the broker-dealer auditor to perform the procedures of the auditor of the parent. However, the auditor should perform sufficient procedures to determine that the expenses to which the allocation agreement is being applied appear reasonable and consistent with the terms of the agreement. Possible procedures, depending on facts and circumstances, could include understanding the basis for significant changes in expenses subject to allocation, comparing expense amounts to the parent or other affiliate records, or testing the completeness and accuracy of the expenses recorded at the parent. And then answer C alone is insufficient because with respect to reasonableness, broker-dealers that are FINRA members are subject to FINRA Notice to Members 0363, which requires the broker-dealer to make a record reflecting each expense incurred relating to its business and any corresponding liability. It states that one proper method is to record the expense in the amount that is determined according to an allocation made by the third party on a reasonable basis. The engagement team should also perform procedures to determine that the expenses allocated to the broker-dealer were accurately determined in accordance with the expense agreement. Typically, the broker-dealer will have disclosed that the related party expenses have been accounted for pursuant to an agreement, and accordingly, procedures to verify compliance with the agreement would be part of testing the accuracy of that disclosure. And then finally, auditors may also need to consider whether a particular expense allocation methodology constitutes an accounting estimate pursuant to the requirements of AS 2501. Now we'll touch on journal entry procedures. Inspectors continue to identify many deficiencies related to the examination of journal entries and other adjustments for evidence of possible misstatement due to fraud. On the left side, we have our common areas of deficiency. These include not obtaining an understanding of the financial processes and the controls over those processes, not identifying and selecting journal entries for testing to address the potential for material misstatement due to fraud, not testing the completeness of the population of journal entries, not testing any of the journal entries that met the auditor's fraud criteria, and or limiting the procedures to certain journal entries that meet the fraud criteria without having an appropriate rationale for such a limitation in its procedures. and also not evidencing an appropriate rationale for how certain factors in AS 2401 resulted in identification of its fraud risk criteria, including the consideration of manual versus automated journal entries. Now, PCAOB staff have observed good practices in the area of journal entry testing, and those are on the right side of the slide. These include the use of an IT specialist or person or persons with specialized knowledge in IT. Audit firms are using such specialists to aid in their understanding of the entity's financial reporting process, including the use of IT systems, understanding controls over manual or automated journal entries and other adjustments, determining whether journal entries are manual or automated, and when testing the completeness of the journal entry population. Audit firms provide examples to engagement teams of characteristics of potentially fraudulent journal entries to consider for selecting journal entries that can be tailored to a specific audit. Audit firms are providing training for all partners and firm personnel on AS 2401, including journal entry testing. With respect to journal entry practice aids, to assist the team in determining and documenting the basis for selecting journal entries to test, audit firms will use journal entry practice aids that include guidance on the requirements of AS 2401, criteria that could be used to select journal entries for testing, testing of entries that meet the selected criteria, and documentation of the journal entry testing. Audit firms are using templates that A, include specific procedures to test the journal entry population, including the completeness of the population, and are required to be reviewed by the engagement partner and the engagement quality reviewer. Audit firms will use pre-issuance review programs focused on journal entry testing. And with respect to software audit tools, aid in the testing of the completeness of the journal entry population and identify journal entries for testing, audit firms will employ software audit tools. Those audit firms require a consultation if an engagement team does not use a software audit tool, or if the journal entries identified by the software audit tool are not all selected for testing. We have a code word, 709.
Cindy, before you go,
Yes.
we are getting a number of questions coming in. We will try to save some time at the end, if we can, to respond to them. So I just wanted to acknowledge that we are getting the questions and we are aware of them.
Okay, thank you. So you've heard this mentioned throughout the day, the audit focus publications that we have, the common areas of deficiency and the observed good practices on the previous slide were taken from the PCAOB staff audit focus publication on journal entries that was published in January of 2025. As mentioned, Audit Focus aims to provide easy to digest information to auditors, especially those who audit smaller public companies. Each edition reiterates the auditing standards and staff guidance, as well as offers reminders and good practices tailored to PCAOB registered auditors of smaller reporting companies, all with an eye toward protecting investors and improving audit quality. In addition to the common deficiencies and good practices, this edition of Audit Focus highlights key reminders for auditors from the PCAOB standards related to journal entries and provides the staff's perspective on common deficiencies made by auditors. And this Audit Focus series is available on the PCAOB website. Turning our focus to regulatory, the percentage of review engagements with deficiencies under AT2 remained flat in 2023 at 40%. As we know, there are a variety of reasons why a broker-dealer might assert that it is not required to comply with the customer protection rule. Most of the review engagement deficiencies identified in 2023 concern auditors that did not take into account and evaluate evidence obtained in the audit of the financial statements that contradicted the broker-dealer assertions in exemption reports. A common example is a broker-dealer that asserts that all of its customer-related business is conducted through a clearing broker under paragraph K2II, but the financial statements or audit work papers indicate that the broker-dealer is engaged in customer security businesses that were outside the scope of K2II. In addition, we continue to observe deficiencies related to broker-dealers that filed an exemption report relying on footnote 74 of the 2013 release adopting amendments to Rule 17a-5. A common issue here is that auditor review reports did not accurately identify the assertions made by the broker-dealer in exemption reports. Let's go over some reminders, starting with performing inquiries. Engagement teams are required to inquire of individuals at the broker-dealer who have relevant knowledge of controls relevant to the broker or dealer's compliance with the exemption provisions, and individuals who are responsible for monitoring compliance with the exemption provisions or controls over compliance. The risk of fraud, including the misappropriation of customer assets, is an important consideration in determining the nature, timing, and extent of the review procedures. In considering the risk of fraud relevant to the exemption provisions, it is important to assess whether the broker-dealer has misrepresented its activities. For example, the broker or dealer claims to be operating as a non-carrying broker or dealer when the broker or dealer is holding customer funds or securities. The auditor's consideration of fraud in the financial statement audit and result of substantive procedures in the audit can inform the auditor's assessment of fraud risk for the review engagement. For example, the auditor's fraud risk assessment in the financial statement audit might identify risk factors regarding incentives, pressures, or opportunities to commit fraud that also warrant consideration in the review engagement. Also, the procedures performed in the audit might provide evidence that the broker-dealer is holding customer funds or securities, which would impact the review engagement. Now, in terms of evaluating evidence, the engagement team's evaluation of evidence obtained in connection with the audit of the financial statements that may contradict assertions made by the broker-dealer in the exemption report represents a source of identified deficiencies. As an example, the exemption provisions established by Rule 15C33 are described in paragraphs K1, K2 K2II, and K3 of that rule, and broker-dealers may also assert an exemption for reasons other than those covered in paragraph K, based on the nature of the broker-dealer's operations. Some broker-dealers that claim an exemption under K2II also maintain arrangements with mutual funds and insurance providers, where the broker-dealer directly introduces its customer transactions to these mutual funds and insurance providers. In these instances, auditors should take into account evidence obtained regarding customer business conducted outside a fully disclosed clearing agreement. Various audit procedures can provide evidence relevant to the broker-dealer's compliance with the exemption provisions. These include testing of customer trades, special designated cash accounts, investment inventory, trading transactions for the broker-dealer's own account, and reading the clearing agreement for testing commission, revenue, and expenses. With respect to reporting, the auditor's review report must include all required elements under AT2. Of particular note, the auditor's review report must include an identification of the exemption report and the broker or dealer's assertions, a statement that management of the broker or dealer is responsible for compliance with the identified exemption provisions throughout the fiscal year and for its assertions, and a statement about whether the auditor is aware of any material modifications that should be made to the assertions for them to be fairly stated in all material respects. Further, the auditor should date the review report no earlier than the date on which the auditor has completed his or her review procedures. Let's look at a reporting scenario. The broker-dealer disclosed in its financial statements that it cleared all customer securities transactions through an unaffiliated clearing broker on a fully disclosed basis and did not carry customer accounts or perform custodial functions related to customer securities. The broker-dealer included the following statements in its exemption report it claimed an exemption from Rule 15C33 under paragraph K2II, the exemption provisions, and that it met the identified exemption provisions throughout the year, except in 2 instances when customer checks were not promptly transmitted to the clearing broker. Based on this scenario, we have a polling question. Which of the following statements would be inappropriate for the auditor to include in its review report? We have reviewed management statements included in the accompanying exemption report in which the broker-dealer stated, A, it claimed an exemption from Rule 15C33 under paragraph K2I. B, the broker-dealer did not directly or indirectly receive, hold, or otherwise owe funds or securities to customers. C, the broker-dealer met the identified exemption provision throughout the year without exception. Or D, the statements in A, B, and C would all be inappropriate. Okay, it looks like majority was D, which is correct. The statements in A, B, and C would all be inappropriate. Answer A is incorrect because the broker-dealer's exemption report stated that it claimed an exemption under K2II, not paragraph K2I. Answer B is incorrect because per the facts, the exemption report did not include the statement that the broker-dealer did not directly or indirectly receive, hold, or otherwise owe funds or securities to customers. Such a statement is typically included of a broker-dealer claiming exemption under footnote 74, but is not a statement required of broker-dealers and exemption reports who claim an exemption under paragraph K of Rule 15C33. And answer C is incorrect because the broker-dealer's exemption report identified 2 exceptions that were not included in the engagement team's review report. The required elements for the auditor's review reports in AT2 engagements are included in paragraph 16 of the standard, which include identification of the exemption report and the broker-dealer's assertions.
Okay, we're getting a little tight for time, and we've gotten a number of questions that we would like to try and address towards the end, so I'm going to go through the next few slides fairly quickly, and I apologize for that. But the next thing we wanted to talk about is our experience with examination engagements under AT1. As you can see, in 2023, we looked at 29 examination reports. We identified deficiencies in 19 of those with a rate of 66%. Most of the deficiencies on examination engagements related to testing design and operating effectiveness of controls important to the auditor's conclusion regarding the effectiveness of internal controls over compliance with one or more of the financial responsibility rules. Just quickly, those rules are the reserve requirements rule, possession or control requirements of the customer protection rule, account statement rule, and quarterly security accounts rule. Some of the more common ICOC-related deficiencies involve testing of controls over the completeness and accuracy of information produced by the broker-dealer or its service organization used in the performance of other important controls, insufficient testing of IT general controls upon which the effectiveness of other important controls relied, and controls with a review element, particularly the nature and extent of management's review, including criteria used by management to identify matters for investigation and how such matters were resolved. So we're going to, next code word is 283. 283, and we're going to skip this scenario and polling question. 283. Sorry about that. Okay. So next thing I want to talk about quickly is our experience with our inspections of supplemental information. Typically, supplemental information includes the net capital computation schedule under 3.1 and the various customer protection schedules, including the customer reserve and the PRC schedule. So in 2023, we looked at 28 examples of the net capital computation, identified 9 deficiencies. We looked at 23 customer protection supplemental schedules and found deficiencies in 7 of those. So those rates are a noticeable increase, particularly on the net capital side from the prior years, and a less, also an increase in the customer protection deficiency rate as well. Okay, so next I want to talk about is non-compliance with PCAOB standards. These are areas that we take a look at that don't necessarily directly relate to the sufficiency of evidence obtained to support the auditor's report. These include auditor independence, risk assessment, consideration of fraud, audit findings, auditor communications, audit documentation, and auditor's reporting on the supplemental information. So just quickly, with respect to audit documentation, that most frequently involves instances where firms did not assemble a complete and final set of audit documentation within 45 days. With regard to auditor reports, that most frequently involved instances where firms omitted or did not properly present required elements in the auditor's report or auditor's report on supplemental information in accordance with AS 3101 and AS 2701 respectively. With respect to auditor communications, most frequently this involved instances where firms did not communicate to the audit committee all significant risks identified during their risk assessment procedures. And then with respect to auditor independence, these are communication situations in the so-called Rule 3526 letter. I don't think we've had any instances of financial statement preparation for a couple of years, which I know was fairly common and significant finding for us in our early years, but now we do see a number of instances where firms are not complying with the reporting requirements under Rule 3526. Some of it is particularly for firms that don't have issuer clients, stems from sort of perhaps a misunderstanding of exactly what the requirement is when you don't have a audit committee per se. I do want to just remind you that in AS 1301, there is a definition of audit committees or equivalents that is applicable to all reports under PCAOB standards. So, and I do also just want to bring your attention to there is an audit focus on audit committee communications, and that is available on the PCAOB website. So that, I'm going to turn it over to you, Alan.
Yes, we'll quickly mention this slide. It is a spotlight that we issued last year. We did cover this in the forum in November, so we won't go into it in any detail. But given the time, I think what we'll now do is pivot over to some of the questions that we've received. And one last polling question.
362.
Code word number. 362. Start, stop, go down. Okay. I think you answered. Okay. This one. Okay. Go ahead.
Okay, so what we're going to do is go through some of the questions that we received. First one, we often get SOC 1s for reliance on the IPE and reliability of the evidence. Most of us never test control effectiveness per se. You focused on the control reliance aspect. I think that the SOC 1 would also be valuable in the former situation. So if I understand the question right, I think when we think about a SOC 1, there is certainly an opportunity to take advantage of having a SOC 1 from a design and implementation perspective, it can certainly be helpful in assessing the controls that are relevant to a particular assertion or set of transactions. Now, whether or not it actually provides reliance around controls depends on whether or not the control objectives that are identified in the SOC 1 are relevant to the assertions or transactions, what the controls that were tested, the results of those tests are, and whether or not those track to either a report or other information that the broker-dealer is using in the preparation of the financial statements. So it would be, I guess, a quick way of saying it would be difficult to say, I can rely on this report only because I have a SOC 1. You have to be able to draw the connection from what's in the SOC 1 to what's in the report, and the assertions or transactions that you're auditing relative to that report. And then you'd be, if you can make that connection, then you could use that SOC 1 to support your conclusion that the controls over the information in that report are operating effectively. You also need to keep in mind that typically in a SOC 1 there will be complementary user entity controls, which are, for those who don't know, those are controls that are at the broker-dealer that the broker-dealer would need to have in place. It would need to be operating effectively in order for the broker-dealer to rely on what's being produced by the clearing firm. So I hope that's responsive to the question that was asked. Okay. I have a question about materiality. Given the discussion about materiality, can one make the case that non-carrying brokers should not be subject to the inspection process? The reasonable investor and risk concepts make more sense vis-a-vis carrying brokers or BDs that are issuers. How are investors protected when there aren't actually any?
Okay, I'll take that question. I like the question. I think it shows that you're thinking, that you've listened to what we were talking about in terms of the standard around materiality, consideration of earnings, and other factors. A few things to clarify. When we say that they should not be subject to the inspection process, well, just want to make sure we understand that an audit where you're looking at materiality and inspecting that audit are two separate things, so they're not linked by materiality. The next comment, or you mentioned the reasonable investor and risk concepts make more sense vis-a-vis carrying brokers or BDs that are not issuers. A clarifying comment, broker-dealers are not issuers. Had they been issuers, they would have been part of the PCAOB inspection process a long time ago. So as it turns out, they used to be issuers a long time ago, but broker-dealers are no longer issuers. And this is why the SEC enacted or removed the waiver for firms that audit broker-dealers to register with the PCAOB back in 2008, et cetera. So that explains that comment around whether or not broker-dealers are issuers. But I think more importantly, how are investors protected where there aren't actually any? So what I like about this question is that it asks a few questions, and if you get to thinking about the standard around, all right, what does the standard require around materiality? It requires you to think of earnings as well as other factors. So if you're citing here that investors, well, if they're not investors in the broker-dealer, they're investors in the market. They invest into issuers. So yes, that's true. But with respect to the broker-dealer itself, they are not actually investors in the broker-dealer. So you'd have to look at, well, who actually owns the broker-dealer? So who is invested in the broker-dealer? So far as investors, as to how they're protected, this is where Rule 17a-5 comes into play, where it combines investor protection, the rules around 15C3-3. It covers the net capital rule. It requires an audited set of financial statements to be filed net capital is really drawn from the balance sheet, and it's got to be GAAP. So all of these things come together to explain why it makes a lot of sense for the SEC to require this annual filing. But perhaps just to get back to materiality and trying to link a reasonable investor or the definition of a reasonable investor and perhaps a customer, I think that's where the standard requires you to consider this and come up with a determination as to what makes the most sense in establishing a level of materiality that would cover the owners and other factors that would certainly include consideration of other primary users. Okay, there's a question here. I think it may have been asked in a prior forum. For monitoring of completed engagements, is deferral beyond 3 years acceptable when an engagement compliance review is scheduled for year 3, but subsequently a PCAOB inspection of an engagement of the same engagement leader is announced and conflicts with the planned engagement compliance review, thus necessitating a deferral? Well, under the interim inspection program, there is no frequency requirement of inspection. So I'm guessing this question comes from a firm that may also have issuers and may be thinking about that 3-year cycle. But for the broker-dealer inspection program, there's no requirement, there's no 3-year, 2-year, 5-year frequency. That will be likely established when we get to a permanent program of inspection.
All right, so we've got, actually we've got 3 separate questions, but all touching on virtually the exact same topic. So have any engagement teams of audit firms identified fraudulent journal entries as a result of their testing?
Okay, well, we won't comment on whether we observed engagement teams to have found fraud. We did observe teams that properly tested for journal entries. We did observe teams that did not. And based on the results of that work, we were able to see what proceeded afterwards. But it's a good question. The standard does require engagement teams to test for fraud. And based on what you find, I think if you look at some of the requirements around the standard is around uniquely identifying characteristics. And do those represent, for example, a management override? And if some of those journal entries were the result of management override, well, what did the engagement team do to get a better understanding of what was behind that journal entry? And in the end, did they conclude that it was a fraudulent entry?
So we're right up at 5 o'clock, so I think we addressed the questions that we had came in most frequently. I apologize, there were a couple we weren't able to get to, but we didn't want to hold anybody up. So with that, we thank everybody for their time. Appreciate you all coming out today. George, did you want to ask George to come up and make some closing remarks?
Great. Well, thank you for the discussion on the BD program, and thank you, most importantly, for everyone that's had the stamina, so to speak, to get through today. It's been a long day, but a lot of important materials have been shared by the PCAOB staff, by the SEC, Office of Chief Accountant, as well as FINRA. Whether you're here or you're online, hopefully it was helpful. As I said at the beginning, we do want feedback about how we can make these more practical, more useful, to be helpful for you all. In particular, I just want to highlight, before I close here in just a second, a QC 1000. The discussion that was had by our representatives from the Office of Chief Auditor, by Lisa and Lynette. Hopefully that was helpful. As Lisa, I think, said very clearly, if you have questions, submit those. There always are responses coming back with the phone number, so I encourage you to do that as you work through QC 1000. So thank you all very much. We greatly appreciate your feedback. We need to listen. We need to hear from you. I appreciate that. I know others at the PCAOB, we all appreciate it. So Safe travels home from if you're here in person. Otherwise, have a great evening, and we look forward to seeing you again at another Small Business Forum. Thank you all very much. Good night.